Hello, I'm Julia Cordova, and I'm coming to you live from the Place Your Trades Network. Today, I will be interviewing Michael A. This podcast is brought to you by Trade, which has a custom advocated trading event contracts, and that is what we're all using at Place Your Trades. Use the link in the chat. Start using the Trade web app for free, or you can follow along and make your own picks. And make sure you like and subscribe to our channel, set your notifications so you never miss a podcast. Thank you. So let's talk a little bit about the market action overnight. So far, we had a pop and then a drop, and we have about 25 minutes until the market opens. I have done a poll on Twitter. You guys have had an amazing track record when I used to run them on Sunday nights. I believe you're 7 out of 8. It could be 6 out of 8, but I believe you're 7 out of 8 for accuracy, which is incredible if you think about it. Absolutely incredible. So please go and vote on the poll, and then I will place the trade you choose. So let's see here. I'm going to just retweet if I see it on the Place Your Trades. I'm following Place Your Trades on Twitter, so I'm just going to see if they. There we go. Okay, I'm going to retweet their tweet there so that you can watch it live if you follow me, and I'm going to like it. Okay. So, yeah, I'm really excited to talk to Michael. Michael is, he's prolific on Twitter. He's super popular. He runs spaces. He talks to a lot of different people, and he knows about a lot of different things. And I personally am impressed by his knowledge, and I enjoy following him. So let's go ahead and talk to Michael. Hi, Michael.
How are you?
I'm very well, thank you. How are you?
I am, as my father used to always say when he was asked how he's doing, he'd say, I'm surviving. I think that's probably the most appropriate way to frame the way I've been feeling this year.
Oh, I understand. I mean, it's been a tough, choppy year. I mean, I have to say, I was so proud of myself because I timed the pullback perfectly at the end of last year and beginning of this year. I went short very close to the top. People told me I was cuckoo, but then I thought potentially we would go more up before down. So sometimes when you have something in your head and then it happens a different way, it is hard to get out of that. But I know in your case, I mean, bonds have not been behaving themselves very well. Is that going to change? Do you think?
Well, it's funny you say that. Sometimes what's in your head doesn't play out right the way that you hope it would. Sometimes the data looks totally different compared to history as you're living it real time. So just real quick on this whole point about bonds, we keep hearing about 60-40 and how horrible a year it's been for 60% stocks, 40% bonds. What made this year so ridiculously painful for rules-based managers like me with my funds and asset allocators is, for the most part, if you didn't short, you really had no chance other than going into long energy to really counter some of these declines, right? So I keep going back to some of these stats, which are pretty extreme. You've never had a year in history where your quote-unquote risk-off safe haven asset, treasuries, lost more money than stocks in a major decline for stocks. You never had a period where the number of weeks that treasuries have lost money is as high as it is this year. 73% of the weeks treasuries lost money. You also had never had a year up until except for 1931, where the S&P 500 had so many down weeks as a percentage of the year. So there's been a lot of really odd, painful, strange dynamics when it comes to markets. Now, the good thing about anomalies is that they end, right? At some point, you have to assume that market's going to go back to the playbook of history, as long as there's still cause and effect, which means that, yeah, probably there's going to be an opportunity for more normalized trading opportunities, which hopefully result in better returns rather than, to your point, the choppiness that most have experienced this year.
Yeah. Yeah. So do you think that energy stocks are amazing, right? Even with the recent pullback in oil, energy stocks are super strong right now. Do you think that's something, is that something you're looking at? Do you think that's something that's going to continue? And let's say the market is weak. Do you think that's something that's going to continue, or is it, or are we going to switch places with something else? And if so, what do you think it will switch places with?
So it's important to know that the idea of the market going down is probably going to still be mostly tech oriented, right? Because tech is such a big portion of the quote unquote market. And I think there's a big distinction between sort of a secular uptrend, which is what I believe commodities as an asset class have, and then relative performance of the energy stocks against the broader stock market. It wouldn't surprise me to see energy be the continuous leader, overtaking tech for several years, right? Because of all the things we know about underinvestment, commodity demand from emerging markets, all this stuff. But relative outperformance doesn't necessarily mean absolute performance, right? So in other words, you could have a continuation of the bear market where energy goes down, but down less than the S&P. I think there was a time during the tech wreck from 2000, 2002, where energy was down 30%, yet it was the best performing sector at that time. All right. So there's because I suspect that the bear market is not over, I think stocks in general are going to have a hard time. Energy might be a relatively better place to be, but just keep in mind that still might mean losses.
Right. I'm curious myself. I'm trying something. I've been short oil stocks for a couple weeks. So I know that's very contrarian, but in my own mind, I thought, you know what, if the market goes down, I imagine they'll go down, maybe not by as much. And if the market goes up, then I think that some of that will be rotation. Not that I don't think you're correct. I think that if for whatever reason, the market continues not, let's say, just stays in this area of chop, I do believe that energy stocks will outperform. But I'm sort of short-term biased, short against oil stocks, which I know is super contrarian. I'm probably going to get hate mail from everybody.
That probably means you're going to be right, as I've said many times. The moment you get people coming at you, and it's so funny because people always they talk about things without, as you're doing correctly, expressing the time frame of their view. It's like you can be bullish and bearish at the same time.
Yes, you can. Not a lot of people understand that. And you know what's funny is they'll bookmark that one thing, and you could be right for 2 months, but then if you're wrong 6 months later, they'll be like, well, how did that work out for you?
I'll give you a recent example of that. So I was on this melt up kick since October 2nd, right on.
Yeah, you were one of the first people on it. Kudos to you.
Yeah, no, and it's not about a call, it's about the conditions, but people say, oh, great call. So it's like, all right, fine. I'm not going to counter it anymore because it's exhausting. But I'll give you a good real-time example of exactly that point. So part of the whole melt-up argument was that you'd have a broader risk-on move and everything. And I tweeted out literally a few days before the FTX blow-up, crypto winter is over. All right, and I was being a little bit brash on it, but I said that because I could see, obviously, the melt-up dynamics were there, and there's a correlation between cryptocurrencies and stocks, and the NASDAQ in particular. And then the FTX stuff started playing out. And the day before that really got in the headlines, I then put another tweet saying crypto winter is back, right? It was a little tongue in cheek, but I was like, and I was showed a screenshot showing the cryptocurrency breakdown. So I kind of flipped very quickly on that narrative. And I see people tweeting at me saying, oh, you're like Kramer. You said that, and then FTX blew up, and it's like, you forgot the timeline, right? That literally a few days after that, I corrected that because there was new information. This is the dilemma with trading and trying to also get the crowd's thoughts. The crowd sometimes is unable to understand chronology, right? The time with which an analysis plays out and how conclusions will alter because of that time.
I 100% agree. And I also think that when for whatever reason, if your account grows, it does just, people don't want to they want to sort of tear down sometimes. A lot of people want to tear down somebody who they view as having more followers than they should, or having more followers than that person does. And I think it just lends to it. I mean, I couldn't care, I don't care, but a lot of people do very much care about the number of people following them. And they think that, I mean, there are people I follow with a couple of hundred other followers that are amazing traders, some of the best people I follow. And then there are some with 30,000 followers, and I wonder if they're parody. I mean, I actually follow one parody and one account they're almost the same, but one is not parody. Yeah, they've tweeted the same things. So, I mean, it's just interesting. You know, sometimes you become a target.
Yeah, but, no, I think just real quick on that. I think it's important to track those that have skin in the game, and to not attack those that have skin in the game. So, look, no one in this business has been more upfront and open than I have been all year. Back in March, I said this is hell, worse than 08, worse than 2020. I could see in rules-based strategies in my funds, which use treasuries, which have nothing to do with me because they're based on the prospectus and the way that the models are run. I was very adamant saying this is very unusual, and I went through a nasty drawdown on my funds because of this anomalous environment, right? And then I'll have people that say, well, you mismanaged your funds. First of all, I'm following the prospectus, but never mind that. Talking about skin in the game, you know, I'm a portfolio manager of 3 funds. You know, to launch an ETF or a mutual fund, on average, you're paying over $200,000 to get it off the ground. Between legal fees, you know, the prospectus writing, the actual exchange, all this stuff. You talk about $200,000 of expense. Now, I'm an entrepreneur. I launched my funds. I'm suffering from not just the peanut gallery attacking, thinking that it had to do with me when it's rules based, but also like I'm doing something nobody else is really trying to do. I'm trying to actually create something different, and I'm paying for it, literally. And so this is why I think also for traders, you got to be very careful with using social media for validation, because to your point, right? You end up having and there's a lot of good people, right, out there. There are that are quiet. Oftentimes they're very quiet, right? That will try to help you out and understand what you're going through when you're in a drawdown, like everybody inevitably is. But my broader point with that is you have to. Part of being a good trader is staying in the game long enough and protecting your mental, emotional health, right? And it's really hard to do that if you expose yourself to a bunch of people that could never walk a mile in your shoes.
Right. Right. That's the thing. I mean, I like you, I try to be transparent, at least when I find something to be high probability. It may be super contrarian, but if it's high probability, I do just try to say, I don't say that it's the right thing to do, but I just say, this is what I'm doing. So, you know, I mean, fade it if you'd like. I don't know. If you make money, actually, and I'm happy for people to make money. I don't care how they do it.
No, and look, I mean, I think it's strange that it's viewed as a competition.
Yeah.
Like it's always about one's personal financial, you know, experiences and what their objectives are. You know, it's a very I just find it to be very toxic, this idea of not that you have to beat the market, you have to beat somebody down when they're not beating the market.
Right. Right. And you're right. Everybody goes through drawdowns. It's ridiculous to think that nobody does. I can't imagine any professional trader or anybody in finance who has not, you know, suffered a bit at the hand of the market at one time or another.
Absolutely. And if they haven't, they will. That's guaranteed. You know,
exactly. So so people sometimes have a wide array of experience here. We have hedge fund managers watching us. We have people who have just started trading. What advice would you give somebody who'd be looking to become a full-time trader? What advice would you give them starting out? How can they shorten their learning curve, and how can they get to where they need to as quickly as possible?
Well, so I'm always of the mindset of kind of the Malcolm Gladwell way of thinking about things, right? You got to spend 10,000 hours to be good at anything. Now, of course, in trading and investing, the reality is that, you know, there's always a degree of randomness and luck, so no amount of incremental hours necessarily makes you better at what you're doing in the small sample. But I do think that I've used that line before. It's like, turn off TV, don't go on Twitter for financial advice, right? Or even ideas and thoughts. I mean, if you're new, read books. Like, let's go back to what the real greats would do, which is they would study. They would take it seriously. They wouldn't be looking at memes and trying to get stock tips and trying to follow somebody else's trade ideas. Like, I use that line. You know, I use that line all the time, right? Amateurs look to the right of the equal sign, pros look to the left, which is me talking about process versus outcome. Yeah. To understand the outcome, you got to figure out a process. But to figure out a process, you have to have the necessary building blocks, which takes time, takes education. I think that's what's really missing. People are just inherently more short-term and lazy in the way that they think about investing and trading, because it's so easy to get into this game because there's the friction transaction costs are so low, because you can start off with just a couple $100 it doesn't mean that you shouldn't take it seriously.
Yeah, no, I completely agree. And I can't believe some of these accounts that just post memes that are super popular. And I just think they can be entertaining. They can be entertaining, but for me, it's distracting. And I want, for the most part, unless I'm bored, there are certain times when I'm really bored on, like yesterday, I was bored for a little bit in the morning. I was like, what is going to come on? Let us get something going on. But, yeah, I mean, I totally agree with you. And I did the same thing when I was a new trader. I had CNBC on. I had like 6 monitors. I had CNBC on. I was like, oh yeah, I'm trading. And then I would hear something on CNBC and I would react to it, and then I would lose money inevitably. It's like, then I was like, okay, I need to do the exact opposite of this because this is really not working. But I think probably a lot of new traders start off that way. And now I'm so simple. Now I just, are there any particular indicators that are your favorites that you would recommend that people watch along with price action?
So everything in my world, which is what my funds are derivations of these concepts, relate to leading indicators to volatility changing. All right. So I put out these 5 different research studies. They won 5 different awards. The awards don't mean anything. It just means that they were validated by others in the industry. Basically, the leading indicators that I track the most are utilities relative to the market. So if utilities outperform the market, that tends to be a signal of higher volatility to come. It's a leading indicator of risk-off dynamics. By the way, that's been spot on this year. Right? And if you used utilities as the safe haven trade as opposed to treasuries, you did far better, than going into treasuries, something which is also historically abnormal. The other one is lumber to gold, which I often talk about because of the link to housing. By the way, that signal's also been right? Lumber's been weak all year, right? And suggesting higher volatility. That's also the irony of my funds. It's like my JoJo bond ETF uses utilities. My RoRo ETF uses lumber to gold as the signal for offense, defense. The signals have been right. The expression has been wrong. The expression of risk off treasuries has been the problem, which is historically abnormal. And then, things like moving averages, I think, are also worth paying attention to. I do think that people don't really understand what moving averages tell you. A lot of people think that moving averages tell you about trend. I have a very different view on that. Moving averages, I would argue, don't tell you about trend, because if you were to backtest a strategy using moving averages, you'd find that you end up underperforming buy and hold in bull markets, in uptrends.
Now, when you say using moving averages, do you mean when you're looking at the slope of a moving average, or do you mean whether you're looking at whether or not price is above or below a moving average?
I've tested both. In this case, I'm more referring to above or below, but even with the slope, it's the same issue. What happens is you have whipsaws from a backtest perspective. So what moving averages do tell you about, though, is about volatility, right? So usually when you're above, say, a 20, 50, 100-day, 200-day moving average, whatever asset class, whatever stock, whatever bond you're looking at, usually volatility is lower in that, right? When you're below moving average, you tend to have higher volatility, more seesaws, right, up and down. So if you view it from that perspective, it gives you a whole different way of thinking about how to play offense and defense.
Okay. Well, no, I appreciate that. All right. Well, thank you. I know you have a hard stop at 9:30. I have to take a trade. I'm just looking at my Twitter now to figure out what I'm actually going to do. So I really appreciate you joining me today, Michael. Thank you so much.
Yeah, no, I appreciate it. And you're always a good follow, Julie. I appreciate it.
Oh, thank you. Thank you. Cheers, everybody. Okay. So if Alex is our producer, Alex, if you could go ahead and share my screen, I'm going to show, let's see. I don't know what's going to come up first. Do I have my screen shared? Oh, let me share it. Sorry. This is all me. You guys, I'm not a morning person. You're used to seeing me on Sundays. I'm like, what is going on here? So anyway, can you see my screen? Can everybody see my screen now? I think so. Yay. Okay, I see it. Okay. So I know I'm not supposed to show charts. Don't tell anybody. But this is a very simple chart, right? This is the 200 daily moving average. This is where we rejected off with this last bear market rally. Here's the September CPI high. And then so far, we kind of, would you call it a bull flag? I don't know. It's kind of messy, but we almost, and I kind of thought that this might happen, that we either wouldn't get to it or we'd sail right through it. And so far, we haven't gotten to it. So we've got sort of a rejection, so to speak. It's one of those magnet rejections, where you put two poles together that are the same. They're like, no. So anyway, and And so this is the daily. And you can see we sort of popped up last night. We're back to where we started. There is a gap up here, just to be aware of. But I'm going to show you one more chart. I know my lines are messy. Just ignore. So this is my daily. This is that same flag drawn in. There's two pivots that I'm watching today. One is on the daily side. One is 3957 for possible support. Another is if it starts to close hourly above 3981. I think that'll mean something as well. And so far, what's interesting is there was there was a gap here at one time. So this gap at 3966 is also providing just very short-term support right now. So with that said, I'm going to show you the Trade of the app. This is the app that we're all using to take the, yes or no trades. Will it close above? Yes or no? And I will say, this it looks a lot better on a phone, right? But I don't have a way to show you my phone. But what I do like about it is instead of going to, what I used to do is in the middle of the night or whatever, I go to investing.com and I'd have to click through the ads, whatever to do it. But also their numbers are not necessarily the contracts that I'm trading or looking at. And so one thing I like about it is I can get just an instant view of what's going on, big picture, right? So I can just flip through the metals, energy, the indices, and I can see right away, just visually, what's going on. So it looks like we popped a little bit back up. And let me take a look at your poll. Okay. Oops. I did the wrong thing again. Mornings, guys, mornings. I can't with this. All right, let's see. So it's yes by 53% for the yes here. So it's 970. Oh, just want to. All right, don't front run me here, people. So anyway, I'm going to go ahead and take one of these, and then what I'll do is I'll wait for a dip, add more of them, and look at my levels that I shared with you, and then we'll see whether or not we're right. It's a 50-50 shot, right? Right. Okay. And the deal is that you win if no matter what these cost. So you can go more out of the money either direction, no matter what they cost. You win $20 if you are correct or not correct. So you don't win it. All right, that's it. I'm going to go ahead and just say thank you so much for joining me today. I appreciate it. This is new on a Tuesday morning. We'll see how it does. I don't know. Let me know. Give me feedback, please. And I appreciate it. So please follow me on Twitter, Julia Cordova Trades, and also Trade and place your trades. Okay. Thank you, everybody. Have a great Tuesday. Okay, bye.